Money and Markets, Series 3, Lesson 3. Every trade has two sides. One side wants to buy, the other wants to sell. But in financial markets, buying and selling don't just describe what you do with a stock. They describe entire industries, entire business models, entire ways of making money. On one side, you have the buy side, the pension funds, mutual funds, and hedge funds that invest money on behalf of clients. On the other side, the sell side, the investment banks and broker-dealers that make markets and keep everything liquid. And right in the middle, between every buyer and every seller, there's a gap. A number, the bid-ask spread. That gap is where the sell side earns its living. In this lesson, we'll map both sides of the market, understand how each one earns money, and walk through the spread that connects them. By the end, you'll see why that tiny gap matters more than most people realize. The buy side is every firm that manages money for someone else. Think of it this way. Millions of people, teachers, factory workers, nurses, put money into a pension fund every month. They don't pick individual stocks. They hand their savings to professionals and say, "Grow this for my retirement." Those professionals are the buy side. Pension funds, mutual funds, hedge funds, insurance companies investing premiums. The defining feature is fiduciary duty. A buy-side firm has a legal obligation to act in its client's best interest, not its own interest, the client's. That's a big deal. It means the pension fund manager can't gamble with your retirement savings on a hunch. So how does the buy side earn money? Fees on assets under management. If a mutual fund manages $10 billion and charges 1%, that's $100 million a year in revenue. The more assets they attract, the more they earn. Performance matters, but size matters more. Now flip to the other side of the market. The sell side. These are the firms that make markets. Investment banks, broker-dealers. Their job is not to invest money for clients. Their job is to provide liquidity, to be there when you want to trade. Here's what that means in practice. A market maker stands ready to buy from you when you want to sell, and sell to you when you want to buy. They quote two prices simultaneously, one price to buy at, and a slightly higher price to sell at. That difference, that gap, is how they earn money. The sell side also provides research, advisory services, and helps companies raise capital through IPOs and bond issuances. But the core of the business is making markets. Standing in the middle, absorbing risk, and earning the spread. If the buy side is the customer, the sell side is the store. The buy side asks, "What can I buy?" The sell side answers, "Here's the price." So now we have two completely different business models operating in the same market. The buy side earns fees on assets under management. Attract more money, manage it well, charge a percentage. Revenue scales with the size of the portfolio. The sell side earns the spread. Buy low, sell high, pocket the difference. Revenue scales with the volume of trades. These are fundamentally different incentive structures. A buy-side manager wants prices to move in the right direction. A sell-side market maker doesn't care which direction prices move. They just want volume. More trades means more spreads captured. This is why the same market can make both sides money simultaneously. The pension fund buys a bond hoping it appreciates. The broker-dealer who sold it doesn't care about the bond's future price. They already earned their spread the moment the trade happened. Two business models. One market. Both essential. Without the buy side, there's no demand. Without the sell side, there's no liquidity. Now let's zoom into the gap between them. The bid-ask spread. Every tradable asset has two prices at any moment. The bid, the highest price a buyer is currently willing to pay. And the ask, the lowest price a seller is currently willing to accept. Some people call it the offer instead of the ask. Same thing. The bid is always lower than the ask. Always, if the bid ever equaled or exceeded the ask, a trade would happen instantly and the prices would reset. Here's a simple example. A stock is quoted at bid $39.95, ask $40.05. If you want to buy right now, you pay $40.05. If you want to sell right now, you receive $39.95. The difference, 10 cents, is the spread. That 10 cents per share is the market maker's gross revenue on every round trip. They buy at the bid, sell at the ask, and keep the gap. Let's see this in the bond market, where spreads are often wider. Market maker ABC quotes XYZ corporate bond at a bid of $100.50 and an ask of $101. The spread is 50 cents per bond. If a pension fund wants to buy 100 bonds, they pay the ask, $101 each. Total cost, $10,100. If that same pension fund turns around and sells those 100 bonds immediately, they receive the bid, $100.50 each. Total received, $10,050. The round trip cost, $50. That $50 went straight to the market maker. For doing what? For standing ready. For being there when the pension fund wanted to trade. For holding inventory and accepting the risk that prices might move against them. 50 cents per bond sounds small. But multiply that by thousands of trades per day, and the spread becomes a serious revenue engine. Here's an analogy everyone has experienced. The airport currency exchange kiosk. You're flying from Europe to Tokyo. You walk up to the kiosk with 100 euros and ask, "How many Japanese yen will you give me?" The screen says, 12,800 yen. You take the yen, enjoy your trip, and on the way home you have leftover yen. You walk up to the same kiosk and say, "I'd like to buy 100 euros back." The screen says, "That'll cost you 13,200 yen. Wait, you sold 100 euros for 12,800 yen. Now buying back those same 100 euros costs 13,200 yen. You lost 400 yen in the round trip. You have the same euros you started with, but 400 fewer yen. Where did those 400 yen go? To the kiosk. That's the spread. 12,800 on one side, 13,200 on the other. The kiosk is a market maker, and the spread is their revenue. But why does the spread exist at all? Why can't you buy and sell at the same price? 3 forces keep the spread open. First, inventory risk. When a market maker buys a bond from you, they now own that bond. If the price drops before they can sell it to someone else, they lose money. The spread compensates them for holding inventory that might lose value. Second, information asymmetry. Some traders know more than the market maker. If an insider is selling, the market maker is about to buy something that's overpriced. The spread is a buffer against being picked off by better informed traders. Third, competition. In a competitive market, many market makers quote prices. They compete for your order by narrowing their spreads. The more competition, the tighter the spread, the less you pay. This is why liquid stocks like Apple might have a 1-cent spread, while a thinly traded corporate bond might have a $2 spread. More competition and more volume means tighter spreads for you. There's one more thing a sell-side market maker sometimes needs to do. Something that sounds strange the first time you hear it. What happens when a customer wants to buy, but the market maker doesn't have the security in inventory? They still need to sell it. They're a market maker. That's their job. So they sell something they don't currently own. They borrow the security from someone who does, deliver it to the buyer, and plan to buy it back later to return to the lender. This is called short selling. And it's not just a hedge fund strategy. Market makers do it every day as part of ordinary business. When demand for a security outpaces what they hold in inventory, borrowing and selling short is how they keep the market functioning. But short selling opens up a new set of risks. What if the price goes up after you've sold? What if you can't find the security to borrow? Next time, we'll walk through exactly how short selling works, step by step. Let's lock in what we covered. The buy side manages money for clients. Pension funds, mutual funds, hedge funds. They have fiduciary duty. They earn fees on assets under management. The sell side makes markets. Investment banks, broker-dealers. They provide liquidity. They earn the spread, the gap between the bid and the ask. The bid is the highest price a buyer will pay. The ask is the lowest price a seller will accept. The spread is the market maker's gross margin on every trade. Spreads exist because of inventory risk, information asymmetry, and the level of competition in the market. Tighter spreads mean a more competitive, more liquid market. And when a market maker needs to sell something it doesn't own, it borrows the security and sells short, which brings us to our next lesson. Lesson 4. How short selling actually works. Borrow, sell, cover, return, and the risk of unlimited losses. See you there.